Hey everyone. So today, with the level of uncertainty, to say the least, that we're experiencing throughout the markets, I wanted to change it up how we're doing these videos and actually do some long form podcast style ones, explaining some more in-depth concepts. The goal with this is to help explain some of the new investment strategies we've implemented into your portfolios, how they can help during these uncertain periods, and how they can truly zig when everything else zags. I was able to interview Paisley Nardini from Simplify Asset Management. Paisley's been on CNBC, Bloomberg, and all the large finance channels discussing something called liquid alternatives, which is also the type of investment strategies Simplify specializes in. In the interview, she breaks down exactly what managed futures are and trend following, and how they can be considered the third leg of the stool in your investment portfolio. So stay tuned, and I hope you enjoy. Today, I want to review something called managed futures, which I started to include in my client portfolios. To help explain what managed futures are, I'm here with Paisley Nardini from Simplify.
Hi, thanks for having me.
Thanks for coming. Before we jump into it, could you maybe give the audience a little bit of information and tell us a little bit about your backstory?
Yeah, absolutely. So really excited to talk about an asset class today that is near and dear to my heart. I think just given the macro backdrop, it's even more important. So thanks everybody that is tuning in to listen to this eventually. But by way of background, I am from Minnesota. Originally, I went to school up in northern Minnesota, University of Minnesota Duluth, majored in financial markets. And so I've spent my entire career in the financial market sphere. I've been a trader, a portfolio manager. I've been on the sales side of the business. I've worked with small advisors. I've worked with sovereign wealth funds. So I really think this gives me a kind of holistic viewpoint of like kind of the different objectives of advisors or institutional allocators face. And so there's a lot out there. There's a lot of noise. And so my job really over the last decade or so has been, how can I distill the noise and help investors think about really fine-tuning and tailoring their portfolios, thinking about risk, return objectives. So excited to be here with you today, Devin, to talk about managed futures and how that can play a role.
Amazing. So maybe I'll get you to start with kind of what are futures and futures contracts?
Okay, great. So let's jump right in. And I think this is an asset class that can be a bit overwhelming. So I really appreciate you focusing on the education around this, because once you get to the nuts and bolts, it's not as scary as it seems. And it actually might be pretty comfortable for a lot of investors, given what we're investing in this strategy is really tangible assets. So we're not talking about discounted cash flows. We're not talking about duration and interest rate volatility. We're really focused on kind of two parts of the market. We'll get into this in a moment, but at the end of the day, managed futures are investing in futures contracts. And so what are futures contracts? First and foremost, futures are derivatives, and we'll talk about that, meaning that we're investing in something that is tied to the return of an underlying asset. So we'll talk a lot about commodities. For example, we'll talk about gold, and we're not trading in actual gold. I'm not receiving gold bars and shipping them out to someone, but we're trading in the price movement of the price of gold, for example. So that's what a derivative is. It's derived from another vehicle. A little bit of background, I think that's also important, just makes it a little bit more approachable, is who participates in futures trading. There's really two silos that we think about when investors are trading in futures. First and foremost, futures for hedging. So this goes back for decades and centuries even. When you think about producers, manufacturers, farmers, exporters, kind of the bedrock of what makes an economy in free trade is how can we think about locking in prices so that there's not volatility for these, for example, farmers. If I'm growing wheat and I know that I need to sell my wheat to a bakery in 6 months, I have no idea what the price of wheat is going to do between now and then. So if I can lock in that price with that baker, then I can go about my daily business and not be concerned that the price of wheat may fall precipitously. So that's one example. What we're talking about when we're referencing managed futures strategies, however, is more the other silo, the use of futures trading for profits. And what this actually does, which is really important, is strategies such as managed futures are going to be buying and selling futures contracts, similar to how a farmer or a manufacturer producer might be, but they're not trying to lock in the future price because they need to deliver wheat or accept gold bars. They're doing it purely to make a profit from an investment perspective. The benefit of this to the overall futures trading market is that it provides liquidity. It reduces volatility. It helps transaction volumes. And so it's kind of this symbiotic relationship between both hedgers and investment strategies that are looking to profit. And the last thing I'll mention on futures is they are a derivative, as previously mentioned, and they actually have embedded leverage in them. And leverage, of course, in any investment realm can work both for and against you. So you only need to put a little bit of money down to get greater exposure. And so again, what that can mean is if markets turn in the wrong direction for you, you can lose more, or vice versa. And ideally what happens is that by putting a little bit of money down up front, and you can make money in increments greater than that initial capital that you put down. So quick overview of futures, a lot more information online if you guys want to jump in. But again, futures contracts are really the bedrock of what we're trading and transacting in within a managed future strategy.
Oh, that's excellent, Paisley. Most investors can easily grasp fundamental research of buying a stock or a company, but something a little bit less intuitive would be investing based on trend following. Can you go into that a little bit and what that approach looks like?
Yeah, so hopefully you guys will recognize we're going to kind of layer some of these concepts before we really get into talking about the performance of managed futures. So now that we know what a futures contract is and the understanding that we're trading the futures contract, we're going to talk about how we get in and out of these futures contracts to make money for these investment strategies. And so maybe one thing too that I should mention before I talk about kind of the price momentum or trend following that I glossed over was what kind of futures contracts exist in the marketplace. And this is just a small sample of the global universe for trading in futures contracts. But this might start to look a little bit more familiar. You'll see on the far left, we have commodity contracts in the energy and metal space, trading copper, gold, gasoline, aluminum, silver. As we move towards the right, now we're talking about more soft agricultural commodities, coffee, corn, soybeans, wheat, live cattle as an example. And then as we get further to the right, more of like the financial market instruments. So we can also trade futures on interest rates, and that can be done globally. Here I just listed a couple examples in US and Canada and some of Europe. And then lastly, thinking about equity indexes, those have futures contracts tied to them. And then far right here, you'll see contracts on currencies that can be traded globally. So if we jump right in then, how are we thinking about taking advantage of price movements within futures contracts for an investment strategy to make money? So if you think about what is trend following, and we'll be combining futures contracts with a trend following strategy, and those two in combination are really what's driving most managed futures. So if you look at the graphic on the far left here, and you'll see I've listed trend as your friend. So if we really think about as markets ebb and as markets flow, there's these price patterns or behaviors that can be captured in order to make money in a strategy. And so if we think about, this is obviously an illustration of just a very generalized return of an asset class. As you'll see, if you're investing in the far left and the bottom of the black line, and then you ride that up, you'll be profiting as those prices increase. And then vice versa, as trends start to turn over, there's this period where you may lose a little bit of money in a trend following. And then the goal of a trend following strategy, understanding that oftentimes you can go both long and short, is that as that trend turns over at the top or the bottom, you'll want to shift. If you're a long position, you'll want to then sell the futures contract. So now you're short. And so as that asset or that futures contract starts to lose money, if you've gone from a long to a short position, now you get to benefit on the way down as well. So you can start to see it's a pretty dynamic strategy that, again, goes both long and short. And then as we think about as the price of that futures contract may decelerate or decline, again, if you're short, you can benefit on the way down. And then those corners, again, is where trend starts to shift, and that's where it can be a bit bumpy in a trend following strategy. But again, if you're able to capture that trend and then shift positioning on the way back up, again, if you've shifted from short to long now, you can benefit. So it's a pretty, again, dynamic strategy. And the way I think about it is we take a step back because we don't want to get too technical, is trend following in essence is a bit of like the Newton's first law of motion, in the sense that objects in motion tend to stay in motion. So that's why there's these trends or price patterns that can be captured. And if you look at any chart of any asset class through time, there's generally these longer trends before things revert or shift direction. And so that's what we're trying to capture, is that longer term behavior. It's very rare that you would look at a chart of an asset class and have it just be like a rigid, up and down line all the time. There tends to be these kind of slower moving trends. So that's what we're really trying to capture. I would also say it's very important is that many of us are familiar with, say, like discretionary strategies or active strategies, in which an individual on a research team or a portfolio manager are sitting down and trying to understand the fundamental drivers of a business, the cash flow drivers of a business to make investments. Trend following strategies tend to be entirely rules based, so it removes the human emotion. And the reason that's important is twofold. As you can see, we're really trying to capture these trends. There can be volatility as they shift. So removing the human emotion in kind of these curves or kind of corners of these shifting trends, I think really helps the strategy stay on track. And it also becomes a really nice complement alongside other maybe more fundamental driven strategies in a portfolio.
I
Hopefully
love
that.
that. I love that. And, just making it a rules based, because I have so many examples. When I was younger, I bought Lululemon stock for $20, and I thought I was a genius when I sold it at $40 because I doubled my money. But if I would have stuck to kind of a more systematic approach, it's much higher than that today. So I think it's a different approach than what is typically in a portfolio as well from that standpoint. That's
Yeah,
amazing.
I would say the good news too is that both $20 and $40 is much cheaper than any pair of Lululemon pants. So
Yeah,
maybe it
yeah,
was a good
exactly.
investment and it
Yeah,
didn't depreciate.
yeah. Excellent. So what are some of the more specific strategies and approaches within the managed futures realm that you could maybe touch on a little bit?
Yeah, so diving then right into managed futures, we've talked about what futures contracts are. We've talked about how we can trade futures contracts within a trend following realm to take advantage of market movements and these longer term kind of price directions. And so how we combine those then to think about what managed future strategies are. And it's really, again, I want to reiterate, they're very dynamic. And this is important because we'll talk about this in a bit here. But as we think about including or incorporating managed futures into a balanced portfolio, a key benefit is diversification. Another benefit is to help reduce the overall volatility of your portfolio because of that lower correlation relative to stocks and bonds. And in order for managed futures to be able to navigate some of these more rocky parts of the market, for example, if equity markets are in a drawdown, how do managed futures strategies make money for your portfolio? Well, if there's volatility in the market, there might be a lot of whipsaws, right? And so how can we think about taking both long and short positions to kind of ride the trends as things fluctuate? In order to do that, you have to be very dynamic. So unlike, again, a strategy where you may look at the holdings and they're pretty static throughout the quarter, managed futures are going to be dynamically updating on a daily or a weekly basis to account for where is the momentum in price trends today. So key characteristics of managed future strategies broadly is they're going to be multi-asset class. Not always, but many are. I shared the screen earlier when we talked about various futures contracts that can be traded in a managed future strategy. We talked about energy, we talked about agricultural interest rates, equity indexes, foreign exchange contracts. So it's really a diversified group of underlying strategies that are traded. And then again, ultimately, that provides us with a really attractive complement alongside just traditional stocks and bonds. We talked about how managed future strategies are rules-based. So we're not looking at fundamental characteristics such as valuation to drive our decision. We're really just looking at the broader macro environment and if price trends are moving higher or lower.
Amazing. Could you kind of give an explanation or show us something of, what's under the hood? What does this actually look like when it's all put together?
Yeah, so here's an illustrative example. And I kind of pieced together just some very high level holdings across different strategies because every strategy in the managed future space is going to look a little bit different than the next. Just like any, if you look at two equity funds, they're going to have different holdings. But these are pretty common futures contracts, that, as we referred to them, that you might see in a managed futures ETF or managed futures mutual fund on any given day. Again, we're able to take both long and short positions. And although sometimes we talk about going short something, it starts to sound a bit scary. If we take a step back and think again that the benefit of these strategies is that they are dynamic, and then they can weather and navigate these choppy parts of the market. So, for example, and just we're recording this in the midst of a pretty meaningful drawdown in equity prices, and we've seen commodity prices roll over as well. And so the ability to take short positions in commodities and then profit off of that, again, just shows how managed futures can be really dynamic versus, say, a long-only strategy. So if we see here across the far left under asset class, you'll see commodities, interest rates, equity, currency, even crypto. That's something we haven't talked about yet today. But Bitcoin futures exist in the marketplace, and many managed future strategies are starting to allocate to them. And so you'll see across the sector and across asset classes, the different kind of subcategories. So in commodities, there's quite a few. We talked earlier, energy, agricultural, soft grains, precious metals. And then the far right, I think, is what's really important. Very dynamic, long and short positions combined into a single portfolio that allows the strategy, again, to kind of weather the bumps in the market. And the one line item I didn't reference yet, which is very important, is at the very top. So you'll see that in any managed future strategy, the futures contracts, again, derivatives, are backed by the underlying collateral in the portfolio. And so this is treasury bills in the strategy that we're referencing here. And so you're just investing in treasury bills as the collateral that allows you to go out and take these long and short positions. And the benefit of that actually is that you also earn the yield on the treasury bills or whatever, short government sovereign contract that you're using as the collateral. So that's an additional source of return in a managed future strategy beyond these contracts, which are the main exposure in the portfolio.
So the typical portfolio, Paisley, that we see is a 60-40 stocks and bonds portfolio. There isn't much diversification in certain environments that we've seen with that approach. What comes to mind is, 2022, where both were negative at the same time, stocks and bonds. What is the correlation, or how does the managed futures strategies in general act versus some of these different things like a 60-40 portfolio or stocks and bonds?
Yeah, so this is probably one of the most important questions, which is going to drive one of the most important reasons why one would allocate to managed futures in a balanced portfolio. Can they provide attractive return? Absolutely. Can they provide unique sources of return? Yes. But why pull assets away from stocks and or bonds? Well, the reason being is that we can provide a really attractive, differentiated return stream versus looking at just traditional stock and bond returns. And so what we'll talk about here is what we call the correlation of managed futures to major asset classes. And correlation is just a fancy way of saying, how do the two return streams of these asset classes move together? And in very simple terms, you can have something that's highly correlated. And just for reference to a correlation, and the numbers that you'll see across the screen are going to be anywhere from -1 to +1. So if two assets are positively correlated, that means that they might move in tandem. So if equities go up and managed futures were positively correlated, managed futures would also go up at the same time, which if all markets are going higher, nobody's probably going to complain too much. And so really why you diversify is when markets turn over. So if equity markets are going down and your managed futures allocation or your bond allocation is positively correlated to equities, it's also going to go down. And so all of a sudden, this means you're looking at your account statement and everything is down across the board. Not ideal for obvious reasons. So by combining assets together that have lower correlation, meaning they're not moving as closely together, they're offsetting each other, they're helping to smooth returns. When one goes down, maybe the other doesn't go down as much, maybe it doesn't go down at all, or ideally, and this is what we'll talk about here in a second, is in the case of managed futures, because they have such low and even negative correlation to traditional assets, they can actually move higher when the other asset classes in your portfolio are moving lower. And so bigger picture, like that's the key benefit of why you would want to introduce an asset class that has low to negative correlation. And managed futures are actually one of the most capital efficient ways in a portfolio that you can look at offsetting that kind of drawdown risk when equities and fixed income go lower. So what you'll see here moving from left to right, we'll get into some of these numbers now. All of these numbers are the correlation, again, between -1 and +1. And it's very rare that you would ever see a correlation of +1 or -1. It's usually somewhere between like 0.4 to like 0.8 is typically when you look at two asset classes together. So positively correlated. But what we see when we look at managed futures relative to all these common asset classes is really low and even negative correlation. So versus stocks, versus a 60-40 portfolio, versus gold, commodities, bonds, really attractive, offsetting, differentiated return stream when we pair managed futures with any of these in a portfolio. So just an example, stocks is one of the main reasons why you would want to offset volatility in a portfolio. Equity markets are down, let's say 10%. Our managed futures allocation, because it's negatively correlated to stocks, means it might even be up. We might see positive returns from our managed futures, even though equity markets are turning over. And again, this goes back to the fact that in managed futures, we can take long and short positions. So hopefully that helps understand the benefit of including these. And again, the biggest objective of this strategy and added to a portfolio is to help smooth returns and protect portfolios when market turbulence hits.
I usually say, it's something that zigs when everything else zags, but I think you said it much better than I ever
I
could.
could have just said that. We could have moved on.
So, Paisley, it's an uncorrelated strategy. Could you maybe go through some of the benefits of why an uncorrelated strategy like managed futures may be something you'd want in your portfolio?
Yeah, great question. So leading on of those last points from like more of a technical numerical perspective, like let's take a step back and think about more qualitatively, why do we want to have managed futures in a portfolio? So we talked a lot about diversification, which I'll come back to, but they can also deliver really attractive returns across market environments. So we're not just saying that invest in managed futures and when the world blows up, your managed futures are going to be there for you. And maybe that's a month or maybe it's 6 months, but like they'll show up for you in the hard times. They will, and they have, and we'll talk about that as well. But it's also important that if you're allocating to a strategy, that they're going to show up for you and deliver some benefit to the portfolio across various market environments. And so we'll talk about some of the historical returns within managed futures, which have about a 25-year history now from like an index or performance tracking perspective. Futures have been around for decades. But positive returns, attractive source of positive return, whether stocks or bonds go up. And that can be anywhere from like a mid-single digit return as high as, say, low double-digit return on an annualized basis. And that wide kind of return band I just provided is because all managed future strategies are very different. They're using different levers in their portfolio. They have different time horizons. And so there's a lot of what we call like dispersion in the asset class, which just means there's a lot of managers that are going to give you very different returns. So finding a strong manager that has delivered consistent returns allows you to kind of achieve that first objective. The second one is lowering overall portfolio volatility. This is a continuation of what we talked about from a correlation perspective. But if we, again, think about equity markets turnover, your managed future strategy might be flat or even higher from a performance perspective. And that can lower the overall portfolio volatility. It'll essentially pull up the overall portfolio return as equities might be trying to pull it down. So again, it can help lower the portfolio volatility or at least narrow the band of how these returns are behaving because it can help smooth the returns. And then I think lastly, which is very important, and again, a key reason why managed futures have been in investor portfolios for decades, is that sometimes they're referred to as what we call crisis alpha. And I actually don't love that term because it sounds a little bit dramatic. But what it tells us is then in these major market corrections, which are generally driven by equity market sell-offs, an absolute return strategy or a diversifying strategy like managed futures need to show up for you, else why have them in the portfolio? And so in each of the four last major market drawdowns, which was the tech bubble of the early 2000s, the global financial crisis, COVID-19, and then the latest environment, which you spoke to, Devin, which was 2022, when both stocks and bonds were lower. In all four of those market environments, managed futures delivered attractive positive returns and outperformed both stocks and bonds. So hopefully these three kind of key pillars of why managed future strategies are attractive help paint the picture of their benefits in a portfolio.
Amazing. So do you happen to have something that can kind of show how these performed during these times of crisis or the not so fun periods that we have to go through when investing?
Yeah, the
Oh,
not so fun
excellent.
periods. I'm hoping as we're recording this, we don't have to add another a fifth time
Yeah.
horizon. Things are starting to get a little shaky out
Yeah.
there. So for now, we'll just focus on the past. And so these are those four market environments and the proof point of how managed futures showed up for investors in each of these four major market crises. So the black bar is what I will draw your attention to. There is a black bar in the COVID-19 section here. It's very small. The point being is that the drawdown in managed futures, they were essentially flat in the very short time period of COVID-19 in March of 2020, when we saw that sharp market correction. Equities were down almost 30%. And so again, outperform stocks and bonds, stocks being in the kind of gold bar, bonds being in like the rust color bar. And so if we go back to that tech bubble, the benefit of managed futures back in the early 2000s was very evident, right? As equities were down almost 40%, managed futures were up almost 50% in that couple of year period. Financial crisis as well, strong, attractive, positive returns up almost 20% when equities were down over 50%. And so now you start to think about, and we'll get to there, but what does that mean? How much should I be allocating, right? If all of a sudden in the financial crisis, my portfolio could have been up 20%, we're not going to advocate for, selling all of your equities and buying managed futures, but it just shows having one allocation in the portfolio that does really well in times of crisis can be so beneficial to keeping you on track for your long-term investment objectives. And then lastly, I think is really important because for the most part, historically, bonds over the last 25 years have been that what we call ballast. They've held the portfolio up in times of equity market stress. But what happens if we have an environment where both stocks and bonds underperform or deliver negative returns? And that's exactly what happened in 2022. And as you can expect, managed futures had very strong performance, both on an absolute and a relative perspective to stocks and bonds. And I think really started to put managed futures back on the map for a lot of investors because they saw the benefit, whether it's managed futures or any diversifier, of having additional levers in the portfolio so that you can kind of smooth and ride through these kind of turbulent market times.
That's really the moment where it started to catch my attention. Using managed futures, staring at a screen full of every investment, being read in 2022 was certainly not a fun time. And having an alternative like managed futures, I think, kind of helps me sleep a little bit better at night.
Yep.
Now, a lot of the times in some of those comparisons, we've seen the bonds do well. Obviously, rates are going lower. But how has it performed versus a general bond portfolio over a longer time period?
Yeah, I think that's really important. So I'm going to jump to the next slide here in a second, but I just want to kind of
Sure.
crystallize the visual
Yeah.
on this slide as it relates to managed futures and bonds next to each other. So to your point, Devin, historically, bonds have shown up as that diversifier to equity. And you'll see here in these times of crisis, which are pretty short pockets, managed futures have or outperformed bonds. And so it might be easy if you're looking at the slide to say, well, great, Paisley, managed futures show up in these times of crisis. But if I'm selling my bonds to buy managed futures, isn't that probably going to be a drag on my portfolio? Because bonds have done really well over the last couple of decades. We've had this kind of secular bull market in bonds with interest rates globally kind of heading lower. So what does that mean when we look at managed futures and bonds next to each other? And you'll see here, the white line is the general benchmark for the managed futures space. Again, that's SocGen CTA index in white. And then the orange line is the US core bond market. And this is going to go back all the way to the end of 1999. And it's going to look at the last 25 years of returns comparing managed futures, again, the white line, to the US core bond market, the orange line. And you can see they've actually kind of performed in line with each other. One zigs when the other zags, to steal your line. And then it was really kind of the latest kind of breakout that you'll see at the beginning of 2022 that I'm circling here, where the white line jumped higher. And that was that inflationary bear market that we experienced in 2022 when bonds got whacked. So the orange line turned over right as that white line was turning up. This shows that diversification. Your bonds sold off, your managed futures delivered for you. And so I'm not going to point at this slide and say, look, managed futures have significantly outperformed bonds over the last 25 years. That's not the case. With the reason we want to show this chart is that for the last 15 years, managed futures and bonds have really provided this strong offset to each other in a portfolio. And you're not sacrificing on the total return objective in your portfolio by, say, allocating away from bonds into managed futures. Actually, you might have performed better, especially in the last several years where bonds have been subject to a lot of volatility just with interest rate movements. So I think, again, it just shows that there's not a major sacrifice by allocating away from some traditional assets. And hopefully we now recognize there's a lot of key benefits to a portfolio by allocating to managed futures.
Amazing. Now, we saw the 2022 period, and you just showed that with the graph, how it the white outperformed over the last few years. I think we tend to, as a general statement, have a lot of recency bias where we look at stocks and bonds and say, well, over the last 20, 30 years, they were uncorrelated and it really worked out well. Is there anything to suggest that may not always be the case?
Yeah, I think you're spot on. I think with anything in investing, there's so much behavioral component. I mean, we're all individuals, we're all humans. I actually minored in psychology, and with my major in financial markets, minored in psychology because I think it's such an important part of what you do every day, Devin. It's an important part what I do as a portfolio manager, an investment manager, is understanding like the human emotion behind things. And so it's so easy for us to get tethered to the recent past or extrapolate what's in front of us today. And one of my colleagues actually said the other day, which I thought was super helpful, was just let's zoom out. Let's take a bigger step back and look at where we've been to try to better understand where we might be headed. There's a lot going on this chart, so I'm going to break it down. But I would focus on the black line, which is the correlation or the movement of stocks and bonds together. And if you look at this blue line, it happens to be kind of the zero axis, meaning every time the black line is above this blue horizontal line, that means stocks and bonds are positively correlated, which means they're moving together. Maybe not, perfectly correlated, but as stocks go up, bonds have gone up, and as stocks have gone down, bonds have gone down. And then anytime the black line is below the blue horizontal line, that means stocks and bonds are not positively correlated. So again, if we think back over the last 15 years, the last 20 years even, we've been in this environment where stocks and bonds have offset each other. They've been below the blue line. They're negatively correlated, meaning when stocks sell off, bonds go up. When bonds sell off, stocks go up. And so it's been so easy for the last 20 years to just say, let's build a portfolio, a 60-40, a 80-20, whatever allocation you want. And all we need are stocks and bonds because they don't move together. They'll help reduce volatility. They'll help us remain, focused on our long-term targets. But interestingly enough, in the last 2 to 3 years, we've started to see this relationship, which historically existed. This goes back all the way to the early 1980s, where stocks and bonds move together. We've started to see that relationship return. And so as interest rates moved higher, stocks and bonds got whacked in 2022. But it's not as though, 2022 was a difficult year and now stocks and bonds are, moving inversely again. They've remained elevated. And so what this tells us is that for the foreseeable future, it's really important to have an additional lever in the portfolio, because if stocks and bonds continue to move together, what's going to protect you in an equity market sell-off? And this is where managed futures come back into play. So I think, again, zooming out, thinking about how tethered we are to the last 15 or 20 years, where we got by with a 60-40 stock and bond portfolio. But it's really important to think about where inflation's at, where rates are at, where we are at from a market cycle perspective to understand the benefit, actually the risk of only holding stocks and bonds in a portfolio. So diversifiers, I think, are going to have a really strong 5 to 10 year run. Just a lot of this driven by this relationship that we're showing here.
That was perfectly said. And it truly, with the geopolitical risks, we don't know how that affects these things as well. One thing I love to share with clients are kind of real life examples of how managed futures have, delivered a return to your portfolio that a, 60-40 couldn't in the past. So is there anything specific from 2024 that shines or outperformed or did something that, is relevant?
Yeah, so I love this question, not because there's so many wonderful examples, but because we started our conversation today talking about managed futures might be overwhelming. And really, when we get to the crux of them, they're very tangible assets, things that we're all familiar with that are just invested through derivatives. So, in a great example of last year that may resonate with people in the room that are chocolate lovers like myself is that cocoa is a contract or a futures market that can be traded again. And we can take long positions, we can take short positions. And cocoa is a little bit of kind of a nascent part of the futures market, right? When we talk about futures, you talk about like the NASDAQ, or you talk about the, Japanese yen. But there's all these kind of smaller agricultural commodities that have seen significant tailwinds in the last couple of years related to weather. And so last year alone, cocoa was one of those markets that was up, depending on your time horizon you were looking at last year, anywhere from 200 to 300%. And so very few investors probably had cocoa in their portfolio directly. Maybe they owned Hershey's or something, a derivative of a company that produces chocolate. But very few probably had exposure to cocoa futures contracts. And then actually within managed futures specifically, very few managed futures strategies had an allocation to cocoa because it is a smaller part of the market. So for a strategy like Simplifies, we look at some of the smaller parts of the market. We look at the price trend of cocoa, and we had really strong performance last year, driven by the fact that chocolate prices are rising because weather-related activity in parts of Africa, where much of the cocoa bean is sourced, were exposed to extreme droughts. And so if you think about it, if there's extreme droughts in an area where you're trying to grow a commodity, and so it can't grow, you can't produce enough supply to meet demand, supply and demand is going to drive the price higher. And that's exactly what we saw in cocoa. And we've already started to see that in the last couple months with coffee. I'm sure many of you are drinking coffee on a daily basis, and you can feel the price pain of that market as well. So again, these are very tangible parts of our daily life that, farmers and producers and manufacturers are hedging on a daily basis. And then strategies like managed futures can also take advantage of some of these price movements in everyday products. So really fascinating part of the market.
I love it. And, just to touch on coffee, I remember when Trump announced he was going to put tariffs on Colombia, the price of coffee just skyrocketed. So again, you just never know when these exposures are going to be helpful in this kind of uncertain world that we live in now.
Yeah. And I would just, maybe the last comment I would make on that is, in the environment that we're sitting in today, slightly elevated, sticky inflation, as we're calling it, starting to come down, but still a bit elevated. That's going to drive a lot of commodity prices higher. Obviously, now that we're in the midst of these tariff wars, what does that mean on imports and exports? That also is impacting a lot of markets, whether it's natural gas type markets, whether it's commodity import markets. And so there's a lot of activity and a lot of potential increases in prices that we can capture really in the next 12 months within strategies that take advantage of kind of long and short positions. So managed futures, I think, are ripe for a really attractive market environment over the next several months. So I'm super excited again that you wanted to bring this education to your clients.
Well, I appreciate it so much, Paisley, and you nailed it. So thank you so much for your time today. And hopefully, we can find another alternative or something that you can explain in the future as good as this, because I don't think there's anyone better at breaking it down and simplifying it. So
Perfect.
thank you so much for your time today.
Yeah. Thanks for having me.
Hey there. Thanks again for watching this video. If you want to watch more videos like this, subscribe to our channel, where we're going to be releasing new videos constantly with burning questions our clients have, or what's happening in the world, or educational. If you want to learn more about Rank and Rice Wealth Management and the services that we offer for our clients, go to our website. We'd love to set up a call and see if we can help you on your financial journey.